Hello and welcome to Trading 5 Talents. In today's video, we're talking about selling covered calls. Before we begin, I just want to say I'm not a financial advisor and this is not financial advice. This content is for educational and entertainment purposes only. Any trades I mention are not trade recommendations, but either an example trade or a past trade that I've made. So please don't enter into any trades that you may see here. Now let's get into the video. Selling covered calls is a part of the wheel strategy in conjunction with selling cash secured puts. If you missed the cash secured put video, there is a link in the description on how that works. The overall wheel strategy is also a separate video that I will also link down in the description. So in this video, we're looking at selling covered calls, the second half of the wheel strategy. So just a quick recap, the wheel strategy is an options trading strategy that focuses on selling options rather than buying them. Now, when you sell a cash secured put, if it expires out of the money, you keep the premium and then you can repeat the process. If it expires in the money, you're going to be assigned the shares and you purchase 100 shares per contract that you sold. Once you have these shares, you use those as collateral, and then you can also sell calls using your shares as collateral. If it expires out of the money, you repeat the process. If it expires in the money, then you're going to get assigned that contract, and now you have to sell your 100 shares, and you're back at the starting place for the wheel. So this video is going to be covering the second half of the wheel strategy, or the bottom half of the wheel strategy, known as selling covered calls. So as we did with selling puts, we are going to be selling calls in a very similar manner. That is, we are going to be selling to open the position. And covered calls are going to involve selling one call option for every 100 shares you own. So that's, one of the keys is you have to have 100 shares. If you have 90 shares, you can't sell a covered call. If you've got 110 shares, you can sell one covered call. The 100 shares are only going to be covering that call option. Those 10 shares aren't going to be involved at all. So they have to be in lots of 100 shares because each contract controls 100 shares. Now, as you do with any option, when you sell it, you immediately collect the premium. Now, if your covered call gets assigned to you, that is, it expires in the money, then your shares are now called away and you sell your shares at the strike price of that call option. So because you're selling your shares, or you potentially could be selling your shares at the strike price that you choose, you have to choose that strike price very wisely. And so that strike price should be at or above your cost basis. If you don't know how to calculate your cost basis, I've created a cost basis calculator. It's a very simple calculator in Google Sheets. I'll leave a link in the description to the video that explains how to use it, and also leave a link to the actual spreadsheet so you can download it for free. So once you've sold your call, now what you're going to do is you need to close that position by buying it back. Well, it doesn't necessarily have to be purchasing it back, but again, just like selling puts, there's two ways to close the covered call. The first is to buy it back. If that covered call is out of the money, you can buy to close for a profit if you want to keep your shares. Once again, I like to look for 50 to 90% of the max profit. On the other hand, you can let your contract expire. And if it's in the money, what I do is I let it expire in the money and then just simply be assigned that contract. That is, I sell my 100 shares at the strike price. If it's out of the money, you're going to keep 100% of that premium that you sold it for, and then you can repeat the process once again. So you can either buy to close or you can let it expire. But if you let it expire, what happens next is based on whether or not your contract expired in the money or out of the money. Now, if you let it expire in the money, that is, your shares are assigned, then you still keep the premium, 100% of the premium. And if any capital gains existed, then you keep those capital gains as well. That is, if you sold your shares at a higher price than what you purchased them for, you keep that profit as well. But again, if you sold your shares at a lower price than what you purchased them for, now you're going to be losing money. So that's why you need to know what that purchase price was, what that cost basis was for your shares. Again, there's a link in the description for the cost basis calculator. So let's jump on over to the brokerage account and then we'll take a look to see how this would work. All right, we are here on Robinhood, and I'm just looking at the 100 most popular list that Robinhood recommends. If you don't have a brokerage account and you are looking for one, then what I'm using here is Robinhood, and there's a link in the description. It's an affiliate link, and if you use that link, then you and I both get one share. Now, if you don't want to use that link and you just want Robinhood without any type of affiliate, just go ahead and go to Robinhood.com and sign up. Again, I like to use Robinhood because the interface, because there's zero commissions, and it's just really easy to use for the wheel strategy. There are other brokers out there, zero commission brokers, but I started on Robinhood a while ago and I've just kept up with it. All right, now if we're looking at selling covered calls, you first have to own 100 shares. So let's just start with Fuel Cell down here. You can see I own 300 shares of this. So I'll click on Fuel Cell. And what I'm going to do, so you can see, it tells you what my average cost is here, but I don't go based on Robinhood's average cost because it's totaling everything, like all 300 shares together as my average cost. Or I don't like to think of my trades as one lump sum. So what I do is I use the cost basis calculator so I can track each lot of 100 shares and know what my cost basis is for each lot of 100 shares. So I don't use this Robinhood as my cost basis. So what I want to do is go to trade fuel cell options, or FCell options, and we're going to be selling a call. So you want to make sure you click on sell, you want to click on call, and let's just say we're going for the August 6th expiration. So click on share price to get the at the money options in the options chain. Just for example, let's say I purchased my shares at $6.50. Okay, let's say I purchased them for $6.50. Now, what I want to do is I want to make sure I sell a call at or above my strike price. Okay, if I purchase them for $6.50, I want to make sure I'm selling a call either at the $6.50 strike price or above. So if we scroll up here, so $6.50 or above. I'm already selling a call. You can see that by this -1 here. I'm already selling a call at the $7 strike price. Currently it's at 8 cents. Now, if we looked at what this call actually was, and let me go to that really quickly. All right, and here it is. Here is the call that I sold on Fuel Cell. Now you can see I sold it for 15 cents down here, this average credit per share. So 15 cents, that means $15 when you multiply it by 100. And you can see that I am selling, which is that -1. The expiration date here is August 6th. And currently, this option is now selling for 8 cents. So I sold it for $15. It's currently $8. That means I should be profiting $7. And you can see that right here. So $7 is my current profit. Now, I've got two options here. I can either close this trade out early. I'm about 50% max profit. Half of 15 is $7.50. So I'm, pretty much there. I could close it early. That is, I would buy it back, and you can see in the desktop version of Robinhood, it tells you buy to close, sell to open. It doesn't do that in the mobile version, at least in the latest release. But I can buy to close it back if I wanted to, or I can let it expire. And if it keeps on going, it's the way that it currently is going, then I can let it expire worthless and just keep all $15. But you can see this graph right here. Let's see if we go back a week. And you can see this graph right here. So it sold as high as 28 cents. I sold it for 15 cents. I'm not exactly sure what date it was. I'll have to check my trade log, but you can see the gradual decrease of the option. This is the theta decay, and this is why theta and time is on our side as option sellers. If you want to know more about theta, then there's a video link in the description about options Greeks. All right, so this is one example. I sold a call on 100 shares of Fuel Cell that I own for $15, and now it's currently profitable for me. So let's see how we would do this for another position that I'm in. Okay, so here's BlackBerry. This is another stock I own, and it looks like I own 200 shares of BlackBerry. Again, Robinhood is giving me an average cost of $11.15, but again, I use the cost basis calculator to determine my own cost basis. Now, if I wanted to sell a covered call on BlackBerry, I would go to Trade Options. I would go to Sell Call, choose my expiration date. I'm just going to select August 6th, and then I would sell a call at or above my strike price. So let's say my strike price is $10.50, and so I would sell a call at $10.50. Now, I don't look at the chance of profit when I'm selling covered calls as much as I do when I sell cash secured puts. And the reason is because I don't mind if my shares get called away. So my chance of profit is not as important to me, because if it expires in the money and my shares get called away, I'm fine with that. If my contract expires out of the money and I keep my shares, I'm also fine with that. So what I'm looking for when selling covered calls is making sure that I have a good premium that I'll sell for, and my strike price is at or above my cost basis, because I don't want to lose money on the shares even though I'm gaining money on the premiums. So you would just simply, let's say I didn't have this, you would just simply click on the plus button, just like the cash secured puts. We are selling 28 cents per share. We're going to get $28, and we can continue, and then you would be able to sell this covered call. You own 100 shares, that's the covered part, and you're selling a call. Now let's go over to the mobile version and we'll see what this looks like. All right, so we are in the mobile version. This is just the, down here at the search, and then 100 most popular, and we were looking at BlackBerry. So we'd simply go to trade options, select our expiration date, make sure you're on sell, make sure you're on call, and you can see this $10.50 strike price, 28-cent credit. So we can tap on that and you can see we can sell one contract. We'd receive 28 cents per share. And so that would be a total of a $28 credit. Now, if we tap review again, this is, again, what's nice here is that it tells you exactly what's going on. You're agreeing to sell 100 shares of BlackBerry at $10.50 per share on or before August 6th. If you aren't asked to sell BlackBerry by then, you'll keep your collateral and the full $28 credit. Now, so if you aren't asked to sell BlackBerry by then, that is, you're not assigned, you'll keep your collateral. That's the 100 shares and the full $28 credit, which you can see we are receiving. So I'm not going to do that. This was just an example, but that's how selling covered calls works. You buy your shares or get assigned your shares, and then you sell a call on it. Now, what happens if you don't have shares and you just simply want to sell a covered call? What you could do is, let's go to Ford, for example. What we could do is first we would buy 100 shares of Ford, and you can see how much it would cost us, $1,395. So let's say I did that. Okay, the market is closed, I can't do it, but this is just an example trade as well. But let's say I did it. I spent $1,395 to buy 100 shares of Ford. So we go to, when we want to sell a covered call, we go to trade options, we select our expiration date, and we go to sell a call. Now we purchase them at what? $13.95 per share. So we need to sell a covered call at or above that strike price, or I'm sorry, at or above that cost basis, at or above $13.95. Well, there isn't a $13.95 strike price. You can see from the options chain that it only goes in 50-cent increments. So if we sell them for $13.50, we'll be losing money on the shares. So what I'm going to do in this example trade is I would sell the $14 strike price. So I tap on that, sell it, sell one of them because I only own 100 shares, and you can see that I would get $26. So if Ford closes above $14, then my option would expire in the money. I keep my $26 and I sell my shares at $14. I purchased them for $13.95. So now I'm making 5 cents per share. So you can see what I would be making here is 5 cents per share, or $5 after 100 shares, $5 plus this $26. So I would make $31 if Ford closes above $14 by August 6th. Now, if Ford closes below $14, I keep my $26 if I let it expire worthless, and I keep my 100 shares of Ford. Then I can turn around and sell the following week's call against these shares. So you can see how if we expire out of the money, we can repeat the process. If we expire in the money, we can not only keep our premium, but also potentially have capital gains on top of that. And then we can go around the wheel and sell cash secured puts. So if you have any questions about this topic or about selling options in general, just leave a comment down below and I'll answer it as quickly as possible. In the meantime, if you want to learn more about the wheel strategy and how I use it for lifestyle trading, click on the subscribe button and turn on the notifications so you can catch all the updates. Until next time, trade wisely and take care.